Pfizer was once one of the biggest winners of the pandemic, but today, the stock is down, growth is slowing, and investors are starting to ask, is this a hidden opportunity or a value trap? Pfizer, founded in 1849, develops prescription drugs and vaccines for a wide range of diseases and conditions. Key products include Eliquis, a leading blood thinner for preventing strokes, and Ibrance, a cancer treatment for advanced breast cancer. The firm also produces a COVID-19 vaccine and an antiviral treatment. Pfizer generates revenue through prescription sales and invests heavily in research and development to drive innovation in areas like oncology, rare diseases, and mRNA technology. The company is currently available with a dividend yield close to 7%, while the 5-year average was only 4.2%. The price-to-earnings ratio is 8.5, compared to a 5-year average of 11.1, while the sector average is currently around 15.6. The expected price range is between $29 and $35, while the current share price is $24.61, making the company appear significantly undervalued. The company pays an annual dividend of $1.72, distributed on a quarterly basis. The next dividend payment is scheduled for September 2nd, and shareholders who own the stock by July 25th will be eligible to receive it. The most recent dividend increase was 2.4%, compared to a 5-year average of 3.1% and a 10-year average of 4.9%. It's clear that the company is raising its dividend at a slower pace, which isn't surprising given the already high starting yield. Of course, this also suggests that no significant revenue growth is expected in the near future. Following the 2008 financial crisis, the company also cut its dividend, so it has currently only been raising dividends consistently for 14 years. The earnings payout ratio is still within acceptable levels at the moment, but expectations for the next 12 months are already around 60%. The free cash flow payout ratio is showing a nice downward trend, and it could potentially drop below 60% as well. However, the company urgently needs to either grow its revenue or slow down the pace of dividend increases if it wants to avoid overextending itself. Earnings per share has been pretty stagnant and sideways, especially if we exclude the COVID period. Free cash flow per share has been growing nicely over the past few years. Both the earnings per share and sales growth charts show a lot of volatility, but this is mostly still tied to the aftermath of COVID and the search for a clear direction since then. The company regularly engages in share buybacks, which is certainly a positive sign for long-term investors. It's also worth noting that the total sales chart appears to be finally turning upward again. Return on equity and return on invested capital are still at acceptable levels, but ideally it would be good to see these consistently above 10% and 8% respectively. The operating and free cash flow margin charts look much better, with the company performing well above minimum expectations over the past decade. There are no major concerns regarding debt. In my view, management is handling it responsibly. However, the interest coverage chart is less reassuring. Over the past 8 years, only the COVID-related revenues pushed it above the expected level. The company is currently available with a starting dividend yield close to 7%, and the most recent dividend increase was 2.4%. It holds a solid A credit rating, which is considered strong. However, if the company is unable to grow its revenue, this dividend policy may not be sustainable in the long term. That said, the stock still appears significantly undervalued at current levels. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Let's start with the numbers. For Q1 2025, Pfizer reported revenue $13.7 billion, down 6% year over year. Non-GAAP EPS $0.92, actually up 10%. GAAP EPS $0.52, down 5%. The revenue decline? Mostly tied to fading COVID-related revenues, Paxlovid, Comirnaty. Some areas like Vyndaqel and Comirnaty still contributed positively. According to CEO Albert Bourla, Pfizer is laser-focused on improving R&D productivity, driving profitability, optimizing capital allocation. Their key therapeutic focus remains oncology, immunology, vaccines, and internal medicine, with more integration of digital tools and AI to improve outcomes. Pfizer sees 2025 as a big year for pipeline catalysts. 4 regulatory decisions expected, like RSV vaccines, lymphoma treatments, 9 phase 3 readouts, new programs kicking off in areas like migraine, Nurtec, oncology, breast, prostate, lung cancer, C. difficile vaccine, weight loss drugs, danuglipron. Dividend remains solid, no cuts in sight. Pfizer returned $2.4 billion in dividends in Q1 alone. R&D spend, $2.2 billion this quarter. Debt is under control, leverage at under 3.25 times, no share buybacks planned this year. 2025 EPS guidance, $2.80 to $3. Revenue guidance, $61 to $64 billion. Pfizer is running a $7.2 billion cost savings program through 2027. They plan to realize $4.5 billion of this by the end of 2025. The goal, improve margins, protect profitability. Positives, solid dividend and cash flow, more focused and disciplined R&D. Oncology, immunology, vaccines offer credible long-term potential. Cost-cutting on track, margins improving. Negatives, COVID-related revenue is mostly gone and hard to replace. US Medicare pricing changes, IRA adding pressure. Growth looks flat for now, not a quick recovery story. Facing generic and biosimilar competition in key areas. Pfizer is no longer a growth story right now. This stock is for investors who want a stable dividend and cash flow. Except that this will likely be a slow defensive play for a while. But if you're after rapid earnings growth or exciting catalysts, Pfizer isn't the place right now. Right now, this is a classic, slow and steady blue chip. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.